Hi, my name is Aziz, a fellow of the Association of Chartered Certified Accountants. Welcome to the course, welcome to part 6B of the course, Bookkeeping up to Final Accounts. Today, I am going to remove the myths surrounding VAT. I will talk about partial exemption of VAT and partial adjustments or double entry as they relate to the VAT. My discussion today will be limited only to VAT as it relates to financial accounting or financial accounting period close. I will talk in more detail about VAT in a future video. Please do watch this space. Now, if I move to the first topic, which is removing the myths surrounding VAT, that is demystifying VAT. Now, why do so many people avoid VAT in the accounts department? Why do accounting staff avoid VAT? Why is it that this dreaded task is usually assigned to a new staff member, while a so-called head of finance is unable to provide any information at all? Why? In that sort of environment, you probably hear something like, well, the person who was in charge of VAT before you came in did not hand over to anybody before leaving the organization, so no one knows anything about it. Well, now, that statement was made by a head of finance. A highly paid head of finance made that statement to a new member of staff. Now, this is where the danger lies of taking a highly paid job without having enough experience to back it up. It's very dangerous. When they get found out, they are shown the exit door. Period. Bye-bye. Now, my own view is this. VAT should not be regarded as something that belongs to Lucifer, to be avoided by everybody. To be avoided by those whose main desire is to survive rather than serve the organization that pays their salaries. Now, VAT is rule-based. It's based on rules. And if those rules are correctly observed, the tax should be a source of enjoyment for whoever is put in charge. So let's face it. VAT inspectors are not bloodhounds or assassins just looking for victims, people to be avoided. So whenever they announce their intention to pay a visit to an organization, a compliance visit, a harmless compliance visit, they are not there to get anybody into trouble. They are just there to ensure that laws are being followed. Really, VAT regulations are being observed. So, if you are a head of finance or a finance manager, please, when you hear about a VAT compliance visit, don't suddenly go off sick or go on leave or suddenly need to attend the meeting somewhere. Stick around, they won't kill you, So, my question is, okay, how do we avoid VAT problems, and how do we identify transactions that involve VAT? How? So, if you work in any organization, especially public sector, and you want to charge VAT on services that your department provides, you should ask yourself, first of all, is the service actually business or non-business? This service categorization is applicable to statutory monopolies, such as local authorities, and public benefit entities, such as colleges. If the service that your organization or department provides is comparable with or can be obtained in the commercial sector, then it is a business activity. Okay? If there are other people out there providing similar services, then that service which your department provides or which your organization provides is a business activity. Should be categorized as a business activity. And if it is a business activity, it can either be exempt from VAT charge or can attract VAT at the standard rate of 20% or at the reduced rate of 5%, or it may even be VAT at zero rate. What I mean zero rate is that if the service is zero rated, you cannot charge VAT on the service, but you can reclaim VAT that other people have charged you on the expenses you have incurred to provide those services. Okay? But if, on the other hand, your department is engaged in what is termed non-business activities, it may be that your organization is a statutory monopoly, such as a local government, or a public benefit entity, such as a further education college, then you should treat them as such. Now, in order to decide whether to charge VAT or not, you need to be familiar with the schedules of 1984 VAT Act. You see, transactions are broken down into schedules. They are listed under schedules in VAT Act of 1984. Now, I will tell you what the schedules are. Schedule A deals with supplies or services on which VAT should be charged at the reduced rate, which is currently 5%. That is Schedule 7A. VAT should be charged at the reduced rate, which is currently 5%. That is Schedule 7A VAT Act of 1984. Schedule number 8. This deals with supplies or services on which VAT should be charged at zero rate. Okay? Schedule 9. This deals with supplies or services that are exempt from VAT charge. You cannot charge VAT on those transactions or reclaim VAT on the purchases that you have made. So in every properly configured accounting system, you will have codes, system codes, and nominal ledger codes. Now, at the configuration stage, system codes will be created and they will be assigned to nominal ledger codes. This enables the nominal ledger to be updated automatically whenever the right VAT code is used. The right system code for VAT is used. If you use the right system code for VAT, VAT charged to various accounts will be automatic. Now, for instance, in State Financial Controller, this is how State Financial Controller is set up. Okay, I will show you. I'll just show you the system codes on the screen in a minute. Now, it's just VAT Financial Controller. T1, code T1. T1 is for standard rated transactions. Standard rated transactions. That is code T1. And the standard rate is 20%. T0 is for zero rated transactions. I'm giving you the system code now. System code. The software code for VAT transactions. Code T9 is for transactions not involving VAT, that is journal transfers and so on and so forth. T2 is for exempt transactions. T4 is for sales to customers in the EU. T7 is for zero rated purchases from suppliers in the EU. And T8 is standard rated purchases from suppliers in the EU. In the nominal ledger, you also have nominal ledger codes in which VAT will be going into. You need 3 codes for VAT transactions in the nominal ledger. You need 3 codes. You have the sales or output VAT account in nominal ledger. The VAT that you charge on your sales is known as output VAT. There will be a code in nominal ledger for that. And like I showed in one of my videos, my previous videos, because you have to pay that VAT to HMRC, it is in the current liability side of the chart of accounts. Okay, when you charge VAT on your sales, the code or that nominal ledger, and you use code T1, which is standard rated, that code will be credited automatically with the VAT that you charged. Okay, on your sales, the net amount will be credited to an income code. Okay. Now, the second code that you will need in the nominal ledger is what they call input or VAT on purchases account. That account in the nominal ledger is where your input VAT or VAT on purchases will be automatically debited. If the transaction is a standard rate, for instance, and you press T1 on your state financial controller, that code will be debited with the VAT element of your transaction. The net amount will be debited to an expense code in the nominal ledger. Okay? Now, those 2 codes at the configuration stage, those 2 nominal ledger codes at the configuration stage will be assigned to the system code for automatic transaction, for automatic entry to take place. You will not have to do all those things yourself. It will be done automatically because the system code have been assigned to the nominal ledger codes. I have demonstrated that earlier on, and you will see it again. Okay? Then the third code that we need is what they call VAT liability account. Now, that is where you will, at the end of your reporting period, say at the end of the month, you will remove all the VAT in the output code account, in the output VAT account that is debited, and then you will credit VAT liability account awaiting payment to HMRC. Okay? Because you have to pay to HMRC. You will then also go into the input VAT account and remove the balance there. That is, credit that input VAT account and debit the VAT liability account. So the difference between the VAT that you have charged other customers and the VAT that your suppliers have charged you is what will be the balance in the VAT liability account, which you will either have to pay to HMRC or reclaim from HMRC, depending on which side is higher. Okay? So, ideally, you should keep an Excel record of monthly VAT balance, of your monthly VAT balances. Sorry, yeah, you should keep an Excel record for monitoring purposes. Now, let me show you that Excel record here. So, yeah, that Excel record will look something like this. On a monthly basis, you can see the input VAT that you can reclaim from HMRC from your purchases. You can also see the VAT that you charged your customers, which is known as output VAT. Yeah? And then you will see that the difference between input and output is what you either reclaim from HMRC. In this case, this business, Joe Blogs, is reclaiming from HMRC instead of paying, because what it has been charged by suppliers is more than what it has charged its customers. I will explain why that is the case later on today. Now, so those three accounts in the VAT, that's input code, input VAT account, and output VAT account, and the VAT liability account, they are very, very important accounts and must always be kept clean. They must never be used as a dumping ground for all sorts of questionable adjustments. Now, this is because if you have a VAT compliance visit, those are the areas that the VAT inspector will look at, will concentrate on the most. And if you have entries in those accounts which you cannot explain, then there'll be a problem. So, if you are ever asked by your superior to post a large amount to any of those accounts, those VAT accounts, ask him or her, that is that superior, or maybe the finance manager or head of finance, to support that instruction with proper documentation and sign that journal. Okay? He must sign that journal. Especially if he's not able to explain to you at all, then there is something going on there and he wants you to take the blame for whatever he's trying to do. In fact, anybody who suggests that in your work environment, that you as an accountant should be the one uploading journals into the accounting system on behalf of everyone, definitely has a sinister motive. Now, this is because whenever the system is interrogated, it could be by VAT inspectors or external auditors or internal auditors, or somebody's just curious. It is your own password, which is your signature, that will be seen on all the journals that have been posted. Okay? And if the adjustment that have been put into the system turns out to be bogus, the individual, the very same individual, that same senior person who wants you to do it, will blame you to protect their own job and their own image. So please, never allow yourself to be set up. Also, using just one nominal ledger code for both input and output VAT, like I said before, input code, input VAT, and output VAT should be separated in nominal ledger for ease of recording and for ease of identification. If the two accounts are lumped together, then there will be a problem, because I have come across that before. Now, what I found is that the IT professionals or IT contractors who configured the system left no instruction manual behind. There was no blueprint, nothing. And that situation puts the organization completely at their mercy, as they can always charge for their time whenever they are asked to come in to resolve a system issue. So, as a head of finance, let me point this out. It is your job to go through the schedules that I've mentioned earlier on, Schedule 7A, Schedule 7A, Schedule 8, and Schedule 9. Go through those schedules and extract details that are relevant to the services which the various departments in your organization provide. Okay? You should extract them. Having done that, you should come up with a VAT reference table or a VAT reference manual, an example of which I'm now going to show you. Okay? VAT reference manual, something like this. You should come up with something like this, and you should be guided by the what they call mnemonic code SLEZO. SLEZO. S stands for standard rated, L for lower rated, E for exempt transactions, Z for zero rated transactions, and O for out of scope VAT scope transactions. Now let me just read a few items to you, okay, based on what I've extracted from all those schedules. This is what a finance manager is supposed to do. It's never to be left to a junior person. Never. Okay? Hot takeaways, for instance. Hot takeaways is standard rated according to the schedule. Education of students aged over 18 on the date of enrollment is a business item. It's a business transaction, but it is exempt from VAT charge. Education of students aged over 18 at enrollment who pay no fees is a non-business activity and is out of VAT scope, out of charge for VAT. Okay? Now, education of students aged over 19 at enrollment who pay minimal fees. For example, disabled students. Okay? Disabled student. That is non-business, but it's also exempt from business activity. Advertising is a business activity, is standard rated. Grant is non-business. Okay? Grant is non-business, is out of scope. Vending machine sales, non-schools, that is business, standard rated. Vending machine sales on school premises to pupils at or below cost is non-business, out of scope for VAT. Sale of vehicles, business, that's standard rated. Okay? Canteen income for staff and visitors, business, that's standard rated. Meals supplies to students or pupils at or below cost, that is non-business, out of scope. Function catering, business, standard rated. Gas, domestic, that's business, lower rated. Gas, commercial, business, that's standard rated. And so on and so forth. We also have equipment hire. Now, examination fees for schools and colleges, that is business, but it's exempt from VAT charge. Okay? Now, let me just point out here that there is no list anywhere for standard rated supplies. There's no list for standard rated supplies. No list. Now, if a supply is not zero rated, it's not standard rated, and it's not at reduced rate, then it is standard rated. If it doesn't belong in any of those categories, that is zero rated, if a supply does not belong in any of those categories, that is zero rated, exempt, reduced rated or out of scope, then it is standard rated. But always seek advice if you are in any doubt. Speak to HMRC. They are there to assist. They are not there to cause trouble for anybody. They are not looking for victims. They just want to make sure that there is no loss of revenue. HMRC does not lose money, and the regulations are being complied with. It is that simple. Okay? Now, after you've produced the list that I've just mentioned, this is a reference table, VAT reference table. Share that list with your departmental managers and accounting staff. Ideally, that list should be included in the induction pack as soon as they join the organization. And those managers should then use the reference manual as follows. When the managers are instructing accounting staff to bill customers for services, okay, departmental managers should indicate the VAT status of each transaction on the instruction sheet, or debt notification as they are called in some public sector offices, so that the VAT can be described correctly as either exempt, standard rated, zero rated, or out of scope for VAT. Similarly, when managers are placing orders for goods or services, they should indicate on the order form that the goods or services are to be used for maybe zero rated, standard rated, exempt, or out of scope transactions. Well, this may not really be that easy, but if a department provides a mixture of vatable, exempt, and out of scope services, this may not really be that simple. But at least, it should not be left for junior accounting staff to guess, because if they do guess, the outcome will be very messy, and your VAT report will never be accurate. Okay? So ideally, every month, departmental managers should be given a list of VAT at various rates which have gone through their cost centers, okay, which relate to their cost centers or departments. This will enable potential errors or omissions to be dealt with at an early stage. It will also enhance the accuracy of your VAT return. See? But if you're in any doubt, seek advice from HMRC, but please ensure that the advice you are giving is in writing. And also, all the efforts that you've made should be accompanied with proper staff supervision. And as a head of finance or manager, you should not be afraid to speak out if anybody is failing or refusing to follow rules. Okay? Don't. Which means you should not have a favorite among your staff. If you have a favorite among your staff and that favorite is probably your somebody who gossips, stabs other people in the back and give information about their colleagues, then of course you will not be able to discipline him or her when they are stepping out of lines, and ultimately your tenure in that environment will not be a success. Now, when it is time to prepare your VAT return, it will be very easy to correctly analyze transactions into various VAT categories. This is the way transactions can be given the correct VAT treatment, and you will not have to lose any sleep whenever a VAT inspector announces that they want to come and pay you a harmless visit. You will not need to go off sick or have to attend the meeting. Okay? Life is that simple. Now, I am now going to move on to partial exemption. Okay? I'm going to move on to the next item on the list is partial exemption. Now, partial exemption comes about when you provide when the services you provide are not really completely either vatable or non-vatable. So you provide a mixture of vatable and non-vatable transactions. So the rules are like this: if the services you provide are completely vatable, that you can charge your customers VAT on those services, either standard rate or reduced rate or even zero rate, then you can recover all the VAT that you have been charged on the purchases that you've made to provide those services. Okay? So you charge your customers VAT at various rates to provide the services. Then the invoices for the goods or services you bought to provide the services can also be, you can reclaim all the VAT on those invoices. If the services you provide are exempt from VAT charge or out of scope, so that the VAT charged by suppliers, by those who supply you goods or services to provide the services, cannot be reclaimed. You cannot reclaim the VAT. The VAT will become part of your cost. If you are engaged in activities that are zero rated for VAT purposes, though you cannot charge VAT on those services, but you can recover the VAT that you are charged, that you have been charged by your suppliers on goods or services that you bought to provide those services. But if the services that you provide are a mixture of vatable and exempt supplies, and you have been charged VAT on the goods or services that you have used to provide those services, then your input VAT becomes what is known as residual VAT. Residual VAT. This is because there is a limit on how much VAT you can recover from HMRC. You see, that non-vatable aspect of your business will put a limit on the amount of input VAT that you can recover from HMRC. Okay? So, if you are able to neatly attribute your input VAT to vatable and exempt supplies, then life is simple. Recover all the input VAT fully attributable to vatable sales in the normal way. You charge VAT, then VAT that other people have charged you can be fully recovered. But all the VAT which you can fully associate with exempt or out of scope supplies cannot be recovered and must be recounted as part of your cost. So, now depending on the circumstances of your organization, you can choose the HMRC approved standard method to recover your VAT or residual input VAT or common VAT as it is called. Now, that standard method works like this. Now, let me just show you. It's on the screen here. Now, this is the standard method. You have to find out what your VAT income is. That is all the income on which you have charged VAT, but excluding the VAT. Total income, total vatable income on which you have charged VAT, but without including, that is the net amount. Okay, in total. It could be for the whole month or for a whole quarter. Express it as a percentage of your total income, but again, excluding VAT. That is vatable income as a percentage of total income, excluding VAT, then multiply it with your residual or common VAT. Okay? Now, from both the numerator and the denominator, as they say, that is the top one and the bottom one, you must exclude the following. You must not include VAT from sale of capital assets. That is, items that are used in your business. If you sell it, say like you sell one of your buildings. I mean, well, some businesses do when they are short of cash. Not a very good thing to do, but it does happen. Revenue from that sale must not be included in the income that you will use to calculate your residual, your partial adjustment, as it will distort, because it's supposed to be a one-off event. If you include it, it will distort your calculation because it's not something that's going to be ongoing. You must also not include incidental income, for instance, bank interest or occasional rental income, if they are not really part of what you call your business activities, normal business activities. So any income from those areas should not be included in your calculation. So normally the percentage that we use to come up with by using the fraction, this fraction, should be rounded up in favor of the business, unless your input VAT is more than 400,000 pounds. That is the VAT that you've been charged. If it's more than 400 pounds, in which case 2 decimal places are to be used. But your business can recover all the VAT without doing this partial exemption calculation if either the total VAT in your reporting period is less than 625 pounds per month on average, and the exempt part of all the income is less than 50%, less than half of the total income. Okay? So that is how that works. But you also have the special methods. Now, the special methods can be agreed with HMRC by organization to suit their circumstances. Now, large organizations, public sector organizations, they do this. I mean, especially public benefit entities such as colleges. Even local authorities do it. They can come up with special methods to calculate their partial exemption. Among the methods used are floor areas used in generating different types of income. Now that again, that I understand is used in property businesses. Staff numbers, also known as full-time equivalent. Full-time equivalent can be used. Okay? FTEs can be used. That is number of people working in different parts of the organizations. You can also use number of hours spent teaching vertical courses as a percentage of total number of teaching hours. Okay? That is commonly used in colleges, but the excuse you get in that sort of environment is, oh wow, because people come and go and so on. It is very difficult to collect the information and so on. So really, now that's another issue. Just leave that. I'll just stay away from that one. Now, but if you, unfortunately, let me just give you some tips. If you find yourself in a disorganized, unstable environment, you have to look at your environment. If you go in as a finance manager and the environment is totally disorganized and very unstable, but please scan your environment in order to understand the situation you are inheriting. Look at your environment very well. Look at the system that has just been that is already there. Even if it's a mess, just look at it, study it very well before you try to bring about changes. Do not just impose changes on them without studying the situation very well. Okay? As you will worsen the situation that you find on the ground, and you will not get any credit for that. Okay? Now, the next thing you should do is look at your environment, look at the file. They are bound to have a VAT file somewhere in that organization. Okay, that file is where past VAT returns will be kept, and correspondence with HMRC will also be there, hopefully. Now, go through the file. Look for a letter from VAT HMRC regarding special exemption methods, which must be used in that environment. If, unfortunately, the most recent letter on file is dated, say, 2001, and you are in 2020, the organization circumstances may have substantially changed since the day that letter was written, and HMRC should have been notified. Okay, they should have been notified. check the partial exemption method that is already there before you came in. Don't just change it. Ask yourself, does it agree with what the letter says? Let HMRC letters, even though it was written more than a decade ago. Okay? And the recommendation may not be obsolete because things have changed. But look at it anyway. Look around you. Look at what is being done. Does it agree with that letter from HMRC? If it doesn't agree, then there is a problem. But again, if HMRC recommendation has never even been implemented at all, if the letter is just there, it's always been ignored, discuss that issue with top management. Okay? Discuss the issue with top management. Make your own suggestions. But if you encounter problems, don't just sit down there. Decide what is best for you as an accountant. You mustn't allow yourself to be set up. It is very, very important, because if you just sit down there, at the end of the day, they are going to say it is your fault to keep their job. Please do what is best for you. Take the right decision. Now, okay, if I now move on to VAT calculation, okay, like I said before, there is a limit on VAT that you can claim if you provide a mixture of vatable and non-vatable transactions because of the non-vatable side. Now, look at the total income from Joe Blocks. That is total income for the year from Joe Blocks. But this income, and total income for the month that we are working on, but this income includes £20,000 grant. This grant has been provided by the Youth Employment Training Agency so that people can be sent from the local college to acquire work experience in that in that environment. So that is non-vatable. As a result of that, you cannot reclaim all the VAT that you have been charged on your purchases, because those apprentices took part in activities in that garage. They helped to fix cars. They participated in VAT, MOT of cars, repair of cars, etc., etc. So it is not possible to specifically say that, oh, this area, this car, this is the one they touched, that is the one they touched. So because of that dilution, you cannot recover all your VAT that you've been charged. So you then have to use the standard method of HMR recommended by HMRC. And based on that, I have done the standard. I have done the calculation here. Okay, this is the net income, total vatable income, net of VAT, total vatable income, net of VAT, and I can demonstrate that by taking you to the extended trial balance here. Okay, now this is the extended trial balance. If I take you to the P&L account side. Okay, this is total vatable income, net of VAT. If I just add them together, plus the grant, okay, that's what it comes to. Yeah, total income from the grant is 31,000 something. Okay, it's also here. Oh, it's not 31,000. Sorry about that. Just. Yeah, so that's total income from plus grant. But the VAT side of it is different. Just 1 second. This is kind of slow. Yeah, this is a different tema here. Yeah. TB5. So, now this is total income exclusive of VAT. £29,589.68. That is what it is. Right. Now, but not all of this income is vatable. This £2,000 is not vatable. It's not vatable. The vatable income is 27,000. This is what is vatable. £27,589 and 68 pence is what is vatable. So what I'm now going to do, what I've done here, I have placed vatable income here. This vatable income. Vatable income as a percentage of total income multiplied by total input VAT. This is the total input VAT. Input VAT is there. It's £12,218 and 57 pence. But we cannot reclaim all of it. We can't reclaim all of it. We can't reclaim all of it because of that. So using that percentage, that fraction up there, I have come up with 9.32%. 0.932 is what we are going to reclaim, which comes to £11,392 and 70 pence is what we can reclaim out of the £12,018 and 57 pence that I've shown you there. Now, the irrecoverable VAT, okay, I will come to how that is going to be treated. Now, what can be reclaimed? The irrecoverable VAT is to be treated as additional cost. Now, in some organizations, they create another nominal ledger code and call it irrecoverable VAT cost account, because if you cannot reclaim it, it then becomes part of your cost. But ideally, you should redistribute that irreclaimable VAT among the costs that you have incurred. Okay? The effect of that is to increase the cost by the amount of the irreclaimable VAT. What I've done here, I've brought all the costs up, okay? The costs incurred, all the costs that brought that VAT about. I have increased each of them with the amount of the irrecoverable VAT using a fraction of each element of cost as a percentage of the total multiplied by the irrecoverable amount. Okay? For instance, spare parts, purchase of spare parts, I have increased it by £455 and 59 pence, which is its own share of the irrecoverable VAT. So the revised cost will now become, after I've posted my journal, will now become 97.65 and 59. Okay? Purchase of spare parts has been increased by its own share of irrecoverable VAT, and the cost has now increased from 3,008 to 39.85 and 96. Okay? Now, as you can see, the irrecoverable VAT has been fully distributed. Now, I'm now going to take you to the double entry side of things. Let me just bring up my journal. Oh, this journal. I just got the journal out. Just 1 second, please. Now, this is the journal. In the journal, the VAT on sales, which is 2030 in the nominal ledger. If I take you to the nominal ledger, the VAT on sales is £5,099 and £5,099 and 94 pence. Will be debited to VAT on sales or output VAT account and credited to VAT liability account, awaiting payment to HMRC. Okay? The input VAT account, the total VAT charged, excluding of course the irrecoverable part, okay, has been credited to input VAT account and debited to VAT liability account. So the difference between the two is what is reclaimable from HMRC. Now, if I show you that on the summary sheet, as you can see, this is the VAT that I'm reclaiming, okay? And this is the VAT that is being paid to the HMRC. Amount being reclaimed is 11,392. Amount being paid is 5,000. So the reclaim part is heavier than the payable part. So which leads to a new reclaim. The net reclaimable amount of £6,292 and 76 pence. I will explain that shortly. Okay. Now let me deal with the double entry side of things first. So you've probably noticed that the previous expected trial balance I used is this one. All these adjustments were there. I put all these adjustments for VA for accruals and prepayment there. Now, the extended trial balance, like I said before, is just a draft. It's a working paper. Once you are happy with these journals, you can then pass the journal to your junior person to post into the nominal ledger. And once you have been posted into the nominal ledger, you then have to clear these areas for new draft journals to come in. So, and that's what I've done. And as you can see, this area is now clear. Now, I am now going to start posting my double entry. But before we go, let me just show you all the various accounts. Okay? 2030. This is VAT payable to HMRC on sales. This account will be debited now, and the VAT liability account will be credited. Okay? And this VAT on purchases will be credited now, and the balance, this balance, okay, will be debited to HAP's VAT liability account. Okay, so now let's do it on the face of the extended trial balance. On the face of the extended trial balance. Now this is not required anymore. I'm just shut it down. So, journal. Right, okay. 2030. I'm going to debit it with that amount. VAT on sales. 2030. Yeah. I'm going to use the adjustment column. See? Now, VAT liability account will now be credited with the same amount. 240. So VAT liability account will be credited. Right. Now, the VAT on purchases will now be credited. Okay, we are moving the balance out of VAT liability account. Okay, but not all of it, as you can say, like I said before, the amount that is irreclaimable will be treated as a cost. So only £11,392.70 will be moved. So we do that. VAT on purchases 1650 will now be credited. And VAT liability account will be debited the same amount. Okay. Now, you must also always say this must always balance. This adjustment column must always balance, because that is what demonstrates what will happen if you post the journal after your journal has been posted. Okay. So all these expenses will be debited to the cost account. Okay. Now 6050, which is VAT on purchase, because you are increasing the cost, you are redistributing the irreclaimable VAT. Okay, 1650, 6050. Yeah. Right, 6070. $255. $325. 6340. $63.40. $63.45. $825.87. $16.50. Yeah, so the adjustment column has balanced, which means my journal will balance whenever I decide to post them. Whenever I decide to post it, sorry. And as you can see, let's go to VAT payable to HMRC. Instead of actually paying HMRC, we are now reclaiming 62. We are reclaiming from HMRC, in short, okay? As you can see there, is there on the liability, on the balance sheet side, we are reclaiming from HMRC instead of paying to HMRC. And you can see all the cost accounts to which I redistributed irreclaimable VAT. You will see that they've also changed. You see, utilities account started with 1214.83, and with irreclaimable VAT added to it, it became 1274 point, which is what is going to appear in the P&L account. It's here. So, and the same thing with all the other costs, which have been increased by irreclaimable VAT, irreclaimable input VAT. So, like I said before, we are reclaiming VAT. This business, Joe Block Auto Services Limited, is reclaiming VAT this time around instead of paying VAT to HMRC. This is because at the beginning, the company incurred VAT on capital expenditure, building extension, computer purchase, etc., etc. Now, this is not always going to be the case, because computer will not be bought every month. Building refurbishment or extension will not take place every month. When all the initial costs, when the VAT on the initial cost is exhausted, the company will be paying VAT to HMRC instead. If you are in an industry that regularly pays VAT, where businesses regularly pay VAT to HMRC, but you are always reclaiming, you see, that will make HMRC inspector decide to visit you. They will visit you to see, because they will know that there's something going on there. So you have to be very careful, okay? They look at businesses industry by industry. If reclaiming of VAT is the norm in the industry in which you operate, then there will be no problem. But if it is not the norm and you are always reclaiming, then they will visit you because they know that there's something going on there that shouldn't be happening. Anyway, I will discuss VAT in more detail, like I said before, in another video, because VAT is a very big area. It's a broad area. But I will discuss it as a separate course. So please do like and subscribe, and you will automatically receive my VAT whenever my video whenever it is out. So thank you very much for your time. Do subscribe and take care. Bye.